Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's top story with you. We're seeing a significant shift in the way online purchases are being taxed, and it's having a ripple effect on consumers and businesses alike. The minimis loophole, which allowed for duty-free imports of goods valued under $800, has been closed. This means that many online shoppers will now face additional tariffs and fees when buying products from overseas. To break it down, the de minimis exemption was a rule that allowed importers to bring in small shipments of goods without paying duties or taxes. However, with the loophole now closed, these imports will be subject to tariffs, which can range from 12.5% to 20% or more, depending on the type of product and its country of origin. We've seen some examples of how this will impact consumers. For instance, a pair of lined slippers made in China that previously cost 30 could now cost 44.37 with tariffs applied. Similarly, a nutritional supplement from Canada that formerly cost 37 could now run 60.117 with tariffs in effect. It's not just consumers who are feeling the pinch. Businesses are also being impacted. Many small and mid-sized companies rely on international trade to stay competitive, and the increased costs associated with tariffs could be a significant burden. On one hand, some argue that closing the de minimis loophole will help level the playing field for domestic businesses and create jobs. On the other hand, others claim that it will lead to higher prices for consumers and stifle international trade. As always, we'll continue to monitor this situation and provide you with updates and analysis. It's essential to stay informed about how these changes may affect your investments and financial decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of high-stakes business deals and international finance. Today, we're examining a critical development in the CITGO sale process, where a special master has recommended an offer from Amber Energy, despite it being $2 billion lower than the bid presented by Dalinar Energy. To break down this complex situation, let's first understand what's at play here. CITGO is a significant player in the oil industry, and its sale has been subject to intense scrutiny due to its ties with Venezuela and the implications for global energy markets. The bidding process has seen several players vying for control, each with their own set of challenges and risks. The recommendation by the special master in favor of Amber Energy's lower bid raises several questions about the evaluation criteria used in this decision. Was it purely based on financial considerations, or were other strategic factors taken into account? How does this impact Dalinar Energy, which had put forward a more substantial offer but was not selected? From a risk management perspective, this situation highlights the unpredictability of large-scale business transactions, especially those involving international assets and geopolitical interests. Companies involved in such deals must navigate through a myriad of risks, including regulatory hurdles, financial uncertainties, and political influences. It's also worth noting that this decision could have broader implications for investors and stakeholders who were expecting a different outcome. The fact that a lower bid was recommended may signal to the market that factors beyond just the monetary value are being considered in these high-stakes transactions. As we continue to monitor this situation, it will be interesting to see how Dalinar Energy responds to this development and whether there will be any appeals or further negotiations. The CITGO sale process serves as a reminder of the complexities and risks involved in international business deals and the importance of thorough risk assessment and management strategies. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's show with a look at the latest market movements and what they might mean for your investments. As we've been discussing throughout the episode, the global economy is always in flux, and it's essential to stay informed about the trends and news that can impact your financial decisions. Today, we're focusing on the recent surge in gold prices, which have seen their best monthly performance since April. According to reports, spot gold rose around 1% on Friday, reaching its highest level since July 17, with a gain of 4.7% in August. This uptick is largely attributed to U.S. inflation data, which has reinforced expectations that the Federal Reserve might cut interest rates next month. A rate cut would typically make gold more attractive to investors, as it becomes less expensive for overseas buyers due to a weaker dollar. Now, let's take a balanced look at this development. On one hand, a potential rate cut could boost commodity prices, including gold and silver, making them more appealing to investors seeking safe haven assets or looking to diversify their portfolios. On the other hand, it's crucial to consider the broader economic implications of such a move and how it might affect various asset classes. We've also seen an increase in bets on a 25 basis point rate cut by the U.S. Central Bank at the September policy meeting, with traders now pricing in a near 89% probability. This uncertainty around Fed independence has contributed to gold's recent gains, as shown by inflows into gold ETFs. As we wrap up today's episode, remember that investing always involves risk, and it's essential to weigh your options carefully. Whether you're considering adding gold or other assets to your portfolio, make sure to do your research, set clear goals, and consult with a financial advisor if needed. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.